Okay, let's just dive right into this explainer because what we're looking at right now is frankly mind-blowing. Picture this. It's 2026, and your bank's AI system, it probably already knows if you're about to get laid off before your own boss even pulls you into a meeting. Seriously. And that credit card in your wallet, its algorithm likely flagged your last relationship breakup days before you actually had the "we need to talk" conversation. It does this entirely based on subtle, microscopic shifts in your spending patterns. Buying more takeout, hitting a different coffee shop, the AI sees the pattern. And if we look over at Wall Street, the shift is even more absolute. Hedge funds have aggressively, and I mean entirely, transitioned to being 100% AI run. We're talking zero humans on the trading floor. It's a ghost town of human intuition replaced by servers. So I have to ask you a really blunt question. If the absolute razor-sharp peak of global finance is fully automated today, why on earth are you still managing your money like it's 2019? Today we are going to unpack the hard data that is completely rewiring how we should think about our finances. We're going to break down every concept step by step so you can actually understand and use this stuff.
So, here is our roadmap for today's explainer. 1. The 2026 finance revolution. 2. 3 major money shifts. 3. AI versus human advisors. 4. Building your AI system. 5. Hidden dangers and mistakes. And finally, 6. The future of wealth.
All right, Section 1, the 2026 finance revolution. Let's take a look at the state of finance right now. If we look back at the timeline, the speed of this transition has been blazingly fast. I mean, think back to 2024. AI in finance was, well, it was essentially a toy. You could ask ChatGPT for some generic budgeting advice, maybe get a nice little meal plan to save on groceries, but making actual consequential financial moves, that still required a human, you, sitting there pointing and clicking buttons on a screen. Then 2025 hit, and that was the breakout year. The training wheels came off. We saw the very first fully autonomous ETFs launch. We had AI agents actually paying our bills automatically, and banks introduced predictive overdraft protection. And by predictive, I mean they protected your account before you even accidentally overdrew it. But 2026, this right here is the revolution. AI is no longer a tool, it's your active financial co-pilot. Large language models today don't just track your dollars like a glorified digital calculator. They act as an incredibly advanced reasoning engine. They're constantly analyzing a massive web of complex variables simultaneously. We're talking about your personal income streams, shifting macroeconomic data, brand new tax laws the minute they pass, and, incredibly, even your emotional state by securely scanning your calendar and messages. Those hedge funds I mentioned earlier, they didn't fire their human traders because AI is inherently smarter in some deep philosophical sense. They did it because AI is infinitely faster, it is drastically cheaper, and it literally never sleeps. It never gets tired, it never panic sells because it had a bad morning. So the question really isn't whether you should use AI for your money anymore. The real question is, how far behind the curve are you already? Moving on to Section 2, 3 major money shifts. Let's break down exactly how AI is rewiring the day-to-day mechanics of finance. Shift number 1 is predictive cash flow management. To put this in perspective, the old way of managing your money was basically like driving a car down the highway at 70 miles an hour, but only looking in the rearview mirror. You log into your app, check your current balance, try to mentally guess what bills were coming up next week, and just kind of cross your fingers and hope for the best. The new way? It's like driving with a super advanced GPS that knows every single pothole and traffic jam 10 miles ahead of you. Your AI knows exactly what's coming. It knows your rent is due on the 1st, it knows your Spotify subscription hits on the 15th, and it knows your paycheck clears on the 25th. But it doesn't just know it, it acts on it. It physically moves your money into the correct holding accounts or high-yield savings buckets before you even wake up to think about it. Because of this perfect foresight, the entire concept of an overdraft fee has essentially been eliminated for people using these AI systems. It's a thing of the past. Okay, shift number 2 takes this automation a massive step further into real-time tax optimization. Let's talk about tax loss harvesting. In the past, you or maybe your very expensive accountant might sit down, look at your portfolio once a year, usually around tax time, and try to rebalance it or harvest some losses to offset your gains. It was a tedious, manual process. Today, AI does this daily, hourly even. Let's say a specific tech stock you own unexpectedly dips at exactly 10:14 a.m. on a random Tuesday. Your AI spots it instantly, sells it to harvest that exact tax loss, and then intelligently reinvests those funds, capitalizing on that exact micro moment of market volatility. Humans just can't do this. We have to eat, sleep, and go to work. Because of this relentless, microscopic level of optimization, people using AI are actively saving an average of $1,200 extra a year in taxes. Think about that. That is literally free money being generated purely by algorithmic vigilance. It's money that used to just evaporate, now staying right in your pocket. And then we have shift number 3, which honestly might be my favorite. It completely replaces those incredibly complex, cluttered banking apps with simple conversational AI. You don't need to be a spreadsheet wizard anymore. You don't need to export CSV files. You can just open your phone and ask it a question in plain English. Like, hey, can I afford a $4,000 vacation to Japan this June? Instantly, your AI cross-references your predictive cash flow, your long-term savings goals, your upcoming calendar events, maybe even historical flight prices, and it gives you a firm, data-backed yes or no, and it explains why. It's exactly like having a highly trained, dedicated chief financial officer living right in your pocket, accessible 24 hours a day, 7 days a week.
Section 3, AI versus human advisors. This is where it gets really interesting. Let's see who actually performs better when real money is on the line. We are going to look at the hard, undeniable numbers from a very rigorous 12-month test that spanned from 2025 to 2026. They started with a baseline $10,000 portfolio. On the left side of this chart, we have a top-rated, highly experienced human fiduciary. They're charging a standard 1.2% active management fee. Over the year, they returned an 11.8% net profit, which is respectable. That brought the total to $11,430. Now on the right side, we have an autonomous AI advisor, specifically Wealthfront 2026, and it's charging a tiny fraction of a percent fee, just 0.25%. The AI returned 16.4%, netting $11,970. But hold on, the raw numbers don't tell the whole story. Here's the absolutely critical context. Remember that massive tech market correction back in March 2026? During that single week of chaos, the human-managed portfolio dropped by 9%. The AI portfolio? It only dropped 4.2%. Why such a huge difference? Because the AI caught the early market signals and rapidly rebalanced the entire portfolio overnight, hedging against the tech drop, while the human advisor was literally asleep in bed. Now, let's scale that up. A few $100 on a $10,000 account is one thing, but if we scale that math up to a $100,000 portfolio, that 4.6% difference means the AI puts an extra $5,400 in your pocket every single year compared to the human fiduciary. $5,400. That's a mortgage payment or a massive vacation just handed to you because the system is more efficient. And look, this isn't meant to be a knock on human advisors. There are brilliant human advisors out there, but they simply cannot compete with 24/7 monitoring and millisecond reaction times. It's a physical, biological limitation, not a lack of skill or intelligence. Humans blink, algorithms don't.
But it's not just about making you money. Beyond generating wealth, AI's ability to protect the wealth you already have is completely unmatched. Let's talk about fraud for a second. Fraud in 2026 isn't just someone stealing your physical card. It involves incredibly complex synthetic identities and hyper-personalized AI-generated phishing attacks that legacy bank security systems simply can't catch fast enough. But an AI finance tool, it learns your highly unique spending fingerprint. It knows that you don't just spend $50 at a restaurant on a Tuesday. It knows exactly which restaurant, what time you usually go, what tip percentage you typically leave, and even if your phone's GPS is currently near that location. Recently, my own AI tool blocked a $3,400 fraudulent charge that originated at 3 a.m. And here's the kicker. It didn't block it after the fact and make me fill out a dispute form. It blocked it instantly mid-transaction before a single cent left my account, purely because it recognized a 15% deviation from my specific historical behavioral fingerprint. In today's world, proactive security is literally the only security that works. If you're reacting, you've already lost. All right, section 4. Building your AI system. Let's get super practical. I'm going to show you exactly how to set this up in about 30 minutes. Think of this as your masterclass blueprint. Here are your 7 steps, using tools like Copilot Money AI or OpenAI Finance Agent. Step 1. Use open banking APIs to connect every single account you have. I'm talking checking, savings, credit cards, student loans, your mortgage, everything. AI needs total visibility to work. If you hide a credit card from it, it's like asking a doctor to diagnose you but refusing to tell them about half your symptoms. Connect it all. Step 2. Set an honest risk tolerance on a scale of 1 to 10. And I really emphasize the word honest here. Most humans wildly overestimate what they can stomach. So be realistic. If seeing your portfolio drop 30% during a recession makes you want to sell everything in a panic and hide cash under your mattress, you need to calibrate that into the AI so it builds a safer, lower yield portfolio for you. Step 3. Define hyper-specific targets. Don't just give it vague instructions like save more money. The AI doesn't know what that means. Say,
Save $20,000 for a house down payment by December 2027, and let the AI reverse engineer the math to tell you exactly what you need to do today. Step 4. Enable simple autonomous rules first. Start with baby steps, like letting it automatically pay your recurring utility bills. Step 5. Set a review cadence. You do not need to obsessively check this daily, but you should take 5 minutes every single Sunday night to just review what the AI did during the week and understand why it did it. Step 6. Create an escalation protocol. This is huge. Tell the AI that any single movement of money over $1,000 requires a physical text message approval from you before it can execute. You are still the boss. And finally, step 7, start small. Only let the AI manage 10% of your total liquid money for the first 30 days. Build trust gradually before you hand over the keys to the kingdom.
Section 5, hidden dangers and mistakes. Because let's be real, what could actually go wrong here? Okay, I know I've been heavily hyping up AI so far, but let me just pause and scare you straight for a moment. You have to ask yourself a very serious question. What happens when the machine gets it wrong? A bug in a video game is funny. A hallucination in ChatGPT when you're writing an email is annoying. But a bug or a hallucination in your primary financial AI, that has immediate, real-world, devastating financial consequences. Your rent doesn't get paid. Your investments get liquidated. The real dangers look like this. First, amplified bias. Remember, AI learns from your past data. So if you have a history of panic selling during market dips, a poorly calibrated AI might learn that behavior, assume it's your intended strategy, and automate your bad habits at lightning speed the next time the market twitches. Second, black box decisions. This is crucial. Never use a tool that just says, "Trust me." If the AI makes a move and cannot give you a plain English, logical explanation for why it just sold a specific stock, drop that tool immediately. Third, over-automation. I've actually seen cases where people completely ignore their AI for 6 months, only to log in and realize it was aggressively optimizing for high-risk short-term gains when they actually wanted long-term safety for retirement. It did exactly what it thought they wanted, just perfectly wrong. And fourth, regulatory lag. AI moves much, much faster than the government. Back in 2025, there was a well-known AI tool that accidentally violated some obscure SEC rules on trade reporting speed. The users weren't being malicious, the AI was just too fast. But those users had to painfully unwind perfectly profitable trades and ended up paying heavy penalties in the process. The lesson here? Always keep your hands resting on the steering wheel for the major moves. So to protect yourself, you need to avoid these massive mistakes. First, and I can't stress this enough, never use free AI finance tools, period. If you aren't paying $10 or $20 a month for the product, then your highly sensitive financial data is the product being sold to third-party marketers. Don't do it. Second, diversify your tools. Don't let one single algorithm from one single company handle your investing, your budgeting, and your fraud detection. If that one system goes down, you're locked out of your life. Use different, specialized AIs for different tasks. Third, never assume the AI is perfectly deterministic. What I mean is, these models are probabilistic. They deal in likelihoods and best guesses based on massive data, not absolute, guaranteed certainties. Always question a move that looks wildly unusual. And finally, do not wait for perfection. Saying you're going to wait to use AI until it's perfectly safe and better is exactly like saying you're going to wait until smartphones get cheaper and better back in 2009. You're just sitting on the sidelines, missing out on years of compounding growth and efficiency. Which brings us to our final section, Section 6, the future of wealth. Let's look at some predictions for 2027 up to 2030. If we follow this current, aggressive trajectory, the next few years are going to be wild. By 2027, we are going to see AI to AI negotiations become standard practice. Picture this. Your personal AI realizes your internet bill went up, so it automatically calls and haggles with your internet provider's AI to get you a lower monthly rate, and you don't even lift a finger. They just sort it out in the background. By 2028, we expect central banks, like the Federal Reserve, to launch direct APIs. This means the literal millisecond the Fed announces an interest rate hike, your portfolio will autonomously adjust itself before the news even hits the TV screen. By 2029, full-service AI-run family offices, which used to only be for billionaires, will handle deep, complex investments, tax strategies, and estate planning for everyday people at a fraction of today's costs. And by 2030, basic automated money management will just be the global default. It'll be as common as having a bank account. By then, paying a human financial advisor will become a pure luxury status symbol. It will be the financial equivalent of hiring a human butler or a chauffeur. You don't need one, but you get one just to show you can afford it. Consider this reality for a second. By 2030, the idea of managing your money without AI will feel as totally archaic as someone sitting at their kitchen table balancing a physical paper checkbook by hand in 2024. The revolution isn't coming, it is already here, happening right now. And the wealth gap between those who are leveraging these autonomous systems and those who are stubbornly doing it manually is widening exponentially every single day. So I'm going to leave you with this provocative challenge to think about long after this explainer is over. Are you willing to connect just one single account this week? Just one. Follow the blueprint we laid out and let an AI manage just 10% of your money for the next 30 days, just to see the optimization for yourself. Or will you continue to manually manage your finances, trusting your gut, and risk being left completely behind in this new 2026 economy? The tools are readily available, the data is crystal clear, and the choice is entirely yours. Thanks so much for joining me on this explainer, and I highly, highly encourage you to take that first step today. Start small, but start now.
Thanks for watching. If this gave you a new way to think about your wealth, subscribe to Langford Invests. Leave a comment below with the one savings move you're making this year, and I'll see you in the next one.